Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, and I'm joined here again with Ben Brayshaw, Dan Mickelin. How are you guys today?
I'm doing good. I'm still recovering from show prep. Wish we were recording that. That would have been an interesting one, but it was it was a good time. Yeah, I'm doing great, Seth. How are you doing today?
Amazing. Good. Amazing.
Let's not ask Dan. Let's not talk to Dan about that today.
Yeah, it'll be better next week.
How are you doing, Dan?
I'm doing great. I am doing great. Looking forward to the show. I think we've got some interesting stuff. I think a lot of people are probably, feeling pretty boozed by the recent turn in the market, but there's reasons for optimism, so we're going to dig into that.
I'm so glad that you said that, Dan. I really appreciate being able to be optimistic, and I think just in life in general, right? If you want to turn on a show that's going to tell you the worst, go to the news. It's there all day long.
CNN.
If you want to hear the best of what is yet to come or what this life has to offer, stay tuned. You're listening to Money on Tap. And today we are going to be talking about cycle sector. What comes next? I'm pretty sure that's where we finally landed. The name which we were having some fun with before the show, folks. If you're not familiar with cycles of our economy or cycles of the market and sectors of the market, we are going to bring together with fireworks, not fire and brimstone, but just fireworks around this show's topic today, and we cannot wait to bring more to you. But Ben, you're on the edge of your seat. I'm just going to step back and.
Oh yeah, I'm pumped about this show. This is I think this show is going to rock. I'm pretty excited because there's a lot of people out there that, they get very dismayed about all the stuff going on, and honestly, all I see is just a massive amount of opportunity when you really just break down the various spaces that you really take advantage of. I think there's areas that you should be aware of very clearly, but there's definitely opportunities out there that are changing the market, changing the way we look at it. I mean, there's things that we haven't considered investing in a decade, and those opportunities are staring you right in the face. I'm excited to share about those today. I'm excited to dive into, there's just so much pessimism around the market, and I can appreciate that. And you're never going to buy the low, but I mean, when opportunity presents itself, be a buyer.
Yeah, I think the articles will point to some of that we're about to get going here with our Money in the News.
Rich young professionals flee New York, California in droves. Study by Ariel Zilber. So, of course, the title there was a heck of a lot of fun. Thank you so much for bringing us this in the Money in the News. New York, California, and Illinois lost thousands of rich young professionals who led Democratic-run states for low tax havens like Texas and Florida, according to study. Imagine that. Now that you have money and are getting taxed, like you've heard others talk about, I'm sure, what happens when you start making a little bit of dough. Uncle Sam gets in there and says, let's go ahead and let's take care of that for you. And they don't appreciate it. And they're finding ways that they can fluctuate or augment their income and lowering their tax basis. Believe it or not, folks, if you can pay less in your taxes, you wind up keeping more money.
This doesn't surprise me in the slightest, and we've been hearing about it obviously for quite a while. We have so many clients in California. It's just crazy because of all the tax planning work that we do around investing and trying to mitigate taxes that people pay. Word gets around. So we do a lot of that. I don't know if this is actually true, but I always used to say I think I have more clients in California than Concord, New Hampshire, where I live, just because there's just so many people in California we work with. The taxes are horrendous there, and I think people are really starting to say, "What am I paying all these taxes for?" I'm still in kind of a quasi lockdown state. I mean, it's the liberal agenda is just overwhelmingly in your face. No matter how even if you're a Democrat, you're even off, kind of caught off guard by it. It's just gone a little too far left for most people. And there's just a lot of moving parts. So people are just fleeing these states looking for. They're saying, "Hey, listen, I don't want to pay these taxes. I'm looking to move." But it's interesting, and it's just the amount of people that are moving. It's astronomical when you really start breaking through the numbers. Yeah,
and this article is focusing on a particular segment, right? It's people 35 years and younger who are making $100,000 or more, at their jobs. So they're looking at this particular demographic and using it, first just tracking what they're doing and how they've moved. But I think it's an indicator, kind of a forward-looking indicator as to, what's to come from these local economies. And, I think for these states that are charging the higher taxes, if they want to maintain that tax base that, is their revenue source, they're going to have to start making some concessions and considerations around this. But the article pointed out a couple of things that I thought were interesting, and it isn't all chalked up to local politics, although I would say that's a significant portion here. I mean, there's too much of a trend for it to be denied. But Illinois came in third, and they specifically referenced the outrageous crime rate in Chicago and how a couple major corporations have pulled out. So you figure the talent's going to leave with them, of course.
Of course.
And then you had the whole notion of the work from home thing, and the states that had the largest uptake of these people on the move out of California, Illinois, and New York were Texas and Florida, right? So leaving Democrat-run states, headed to Republican-run states, better taxes, but also able to maintain the beach feel, right? And a lot of these people are probably in the work from home community, or at least some measurable percentage of them. So they're able to leave California, but pay less taxes and stay by the ocean.
Well, I think I think the article just references, and I know it's great that they're talking about kind of that millennial, wealthier, group of people, and those are the people that are kind of driving our next workforce. They're the next CEOs, the executives, the VPs. That's really where that's going to come from. But I think what's really interesting is Moody Analytics actually said that since February of 2021, 46 million people moved to a different state zip code. I mean, different zip code, I should say. So, I mean, that could be within a state, unfortunately. Like, we don't really know how many people, but that's 46 million. Yeah. That's like 15% of our country.
Yeah, this is the GOP-run states added 341,000 jobs in the last 2 years. And in that same period, blue states lost 1.3 million jobs. Yeah. So, I mean, there's the numbers just tell the story. I mean, there's no way to sugarcoat that.
I mean, 20 years ago, 9/11, I remember I was driving into New York City, and I was on 84 heading west, and heard about the first plane hitting the tower, and just got off the next exit and turned around, called my wife, and said, "We're not moving to New York." I mean, there's been a lot of these kind of like, don't move to a blue state kind of conversations in this world, unfortunately. And so this, I think, this kind of solidified a lot of people on, I remember talking to my brother-in-law, Tim, and he was just saying, he's like, I never really thought the governor's race was really that critical in my everyday living. And now it really is. Like, I never thought that, the local and town people would be so important in my voting. I really didn't pay a lot of attention to it. And he's right. I really didn't give it the same fair shake of, what do these people stand for? And when the time comes, these people get, tragedy, crisis comes, these people get real power. And that's something to be aware of. And I think these states are, reaping the ramifications of those decisions.
Massachusetts was listed here too, where had a significant outflow, a net outflow of about 2,000 people in this demographic. In us here in New Hampshire, see a lot of those people come across the border. And unrelated to this, I just actually read this article this morning. It was interesting, and we didn't even include this in the show prep, but it was an article about the top 150 safest cities in the U.S., and Nashua, New Hampshire came in number 2, and Manchester, believe it or not, was number 25, which I found kind of shocking, actually.
Manchester's 25? It's even made the list?
City. Yeah, 25th safest city. I don't want to walk around Manchester too often myself, but anyway, interesting to read. And
think about the tree streets, and I'm not going there for anything.
Yeah,
so.
It's Yeah, Nashua number 2. So anyway, it's people from Massachusetts, these young earners coming across the border for a better tax base. We're used to hearing that. I mean, that's been a long-running story, but no, sounds like that trend's going to continue. And next up, we have an article here from CNN. Don't worry, there's still hope for the stock market. And this is from Paul LaMonica. This article, I think, I found interesting because it references a little bit of where we've been, which ties into the show topic, and talks about some of the the downfall we've seen and kind of lack of performance in the market, but gives us some pretty positive indicators looking forward as to what we can hope for and expect. And really the key thing is here, is hitting at the volatility. I mean, we've seen a lot of seesaw back and forth action in the market, some huge days down and followed up by big days up. But in particular, the article points to 2 major positive performance days that we've had, and how that's an indicator looking forward that the market will do better. So it could be a sign that the bear market hit the bottom when the S&P surged by 5.7% in 2 days over the last couple of weeks. So when we have a situation where the market has these majorly up days, if you look forward 6 and 12 months down the road when that's happened in the past, the market has always been higher. So I think that's the good news that they're pointing to, is that we've got a couple of similar days' performance that have been a leading indicator for forward-looking growth.
Yeah, I think, the thing is people get really, really excited about the market moving, and then all of a sudden you're like, oh, did I miss it? Do I need to buy something right now? This thing is still cheap. I think that's where stability in your purchasing is missing when people start chasing moving markets. You have to look at an asset and say, do I think that this is a good value at its current offering? Do I think that, this is where I would really be happy with an entry point no matter what? And does my time horizon afford me the ability to get through whatever rough roads that we're dealing with here? I think that's the piece that misses in a lot of people who are managing their own money, is really just making a good assessment on a company or a stock or whatever. I usually tell people that in this kind of unforgiving market, because that's really what it is, right? You buy something, all of a sudden, next thing you know, it's down, and you're scared. Did I make a mistake? The unforgiving market really plays best with a stock that's paying dividends. I really find high yield stocks are, and even if it's not a high yield stock, if you're still buying more of that stock as the market's going down, and you're using those dividends to buy more of that stock because you believe in the company, you think, hey, this is a good long term hold. Even if I'm never going to buy the bottom, which no one is, okay? Those bottoms and highs are made by large purchases or large sells that happen all at once, and it's just we're dumping a company or something like that. You'll see the stock just crash. So you're never going to really ever buy the bottom or the top. I can say that I've probably been with somebody that made the bottom or made a top at one point and was lucky at it, but if that's what you're waiting for, you're never going to hit it. So if you have, seller's remorse, like you sold a stock, made money, and then it goes up another 5 or 10%, and you have seller's remorse, well, you're really probably not well educated enough to understand that you're never going to get the top. And you have to be really happy with just making money on an investment and not be disappointed that, hey, I missed out on that opportunity to make inch a little bit more. That's the part that I think is really the problem inside a market like this. These 2 great up days, these surging experiences, we're going to see more of those. But I think the capitulation that's going to have to happen in this market to the point where people really feel, I don't know about you guys, but I don't feel that we've really had that moment of true surrender. I think there's this moment of true surrender in the stock market that really creates that bottom where it's just like, I got nothing to lose. I've sold everything I'm going to sell. I'm a buyer now. What else am I going to do? That moment of surrender is when you really know the bottom is there.
Yeah, the interesting moves in the market, so large for what we're used to seeing, really was a signal for a lot of people that the short sellers out there, the people that took positions and sold the market a while ago, well, in order for them to actually make money on selling the market, well, they have to put in a buy at some point in time to be able to actualize that profit there. I know that for a lot of people that doesn't make much sense. How do you sell the market at a loss and make profits on it? But that's a short sell on the market. Well, when they came in to cover those positions, which inevitably they have to do, That's one of the main reasons that the market was pushing so much higher. And one of the things that we like about that is it can be one of those signals for us that this short sell or short sell rally in the market is a position of a bottom and an opportunity. And especially any time that we're looking at, like, what's the market sentiment? And if you have a whole bunch of people out there, woe is me, and the market is pulled back, and it's gotten really scary, and pretty much everybody's wondering, what do I do? Do I sell? And so many people are. That's when people that have the ability to step aside from the market and understand it from less of an emotional perspective start moving in and creating those buys and taking those positions. That's where the majority of the money gets made in these markets, folks. So pretty exciting stuff to see happen in our market, where we've been on a selling streak here for a while.
Yeah, it comes back to a point we've hit on a number of shows when we talked about styles of investors, and the most common, truest theme that we've come across is that timing the market's impossible. The best thing you can do for yourself is have time in the market. So be there, be invested. Certainly make decisions on individual stocks as you see fit. You'll never catch that exact bottom. You'll never sell at the exact peak. Be in the market, stay invested, and use it as a tool over the long term to keep yourself well diversified and funded for retirement. All
right, folks, that's going to do it for us in Money in the News. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about cycles, sectors, and what's next. We're spending some time in the market with you guys today. Super pumped about this show. Don't go anywhere. We'll be right back.
Folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space. And what we'd love to do is to open the doors to you with us at Brayshaw Financial Group, so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we are talking about cycles, sectors, and what's next in the market. If you've been tuning in so far with us, it's been quite a ride. We've been having some really fun shows lately. I think this is going to be a great continuation of, what's next in the market, how you can be, stepping in to your investments and taking part in your retirement.
Cycle, sectors, and what's next. I'll tell you what's next is 75 basis point hike by the Fed is what's coming after the
bring it on.
The inflation report this month, 8.2. I'm just can't believe that. Boy, it's almost like we can't even nudge this thing. I don't really know that raising rates is going to do anything more than just tranche us into a recession that's going to hurt hard because too many people are still trying to catch up with the demand that they had.
Yeah, I mean, it's clear that the goal here for, again, the crystal ball guys, whatever's driving this conclusion for them is that they absolutely have to crush demand. And that's, they're willing to sink the market and put people out of work in order to get there, which, seems draconian and counterproductive and just all kinds of backwards, to be honest with you. But
it really does, because the thing is they're citing that rent is the number one of the top two reasons for the increase to 8.2. And as you continue pushing rates up, like, you're just going to make, the real estate world literally more expensive. So I don't.
So mortgage rates are knocking on 8%.
Yeah.
So I just saw something else where rents in some major, metropolises, particularly Boston, Chicago, New York, LA, up over 20% year over year.
Yeah.
I mean, and still driving inflation and still raising rates.
And then food's next. And then you start looking at the fact that you've got, the all-time high, oil and gas. I mean, hey, we're down from the top, but we're still up, 100%. So.
I mean, I wonder what kind of parade they're going to throw when inflation finally drops and we're all living in poverty and homeless. Yeah.
Oh, wonderful.
Great. We got there finally, guys.
Thanks, guys. You really did a great job printing $12 trillion. It's like we couldn't put $5 billion towards the wall in the southern border, but we can send $700 million to Ukraine.
I mean, if they can print me a tent I can sleep in tonight.
Guys, calm down. Calm down.
You did say this was going to be a fun show, didn't you say?
This went south real quick.
Holy cow. Hold on to your seats, folks. We're about to launch this one.
Yeah, turn us around, Seth. Let's get going.
Oh, my gosh. All right. So, hey, there's a lot of different ways that you, as an investor, I got to believe that you're an investor out there. If you're listening to Money on Tap, that's what you do. You pay attention to your money. You're smart with your money. You're looking for the opportunities, and you've got a big picture, long-term plan, right? That's what our Money on Tappers are all about. Take a look at the three-dimensional perspective. Guess what? Money goes up and it comes down, right? This is a cycle. This is our industry. This is our world. And right now, you're on the big kids ride, folks. That's what you're on. And it is coming down. And you've been on it, and you've been holding on to your seat. And maybe you're like, hey, Mom, let me off. I'm ready to go somewhere else. Let's take a vacation from this. I get it. But what this is really going to bring about for us is just some really neat things for one, to do a show on. Let's get honest here. And also opportunities for this next cycle. Because guess what? You're sitting at the water cooler having that conversation with all your friends. Well, nobody out there is talking about, oh, my portfolio was $1 million and now it's 700 or whatever it was. Now, people aren't typically having that conversation at the water cooler. Everybody's talking about their winners, and we're going to give you some opportunities to step in and be a winner. But you got to take risk, folks. That's one of the things that's just going to come with it. Is there's the risk on and then there's the risk off, and we're going to hit both of them though. All right. So, which one are you? What part are you at? And let's go ahead and tackle this. So sectors, right? Are you familiar with what a sector is when we say sector in the market? Okay. Well, I'm not going to leave you flat there. We actually have
everyone said yes,
information for you. well, I was hoping you'd call in right now and answer that question for me. So crickets over here. Come on, people, pick up the phone 855-226-8551. Let us know. Sectors, like for instance, everybody right now that's in their car listening to us on the radio happens to be a part of that sector of transportation. All right. There's consumer staples, there's energy, there's pharmaceuticals, there's all these little, kind of compartments of our ecosystem of the market. And not every one of these, sectors is a turnaround on your financing. It's not like you can take a look and say, hey, everything in this sector is going to be a winner. Not that you thought that. But as a whole, broad market, there are some of these sectors that are going to perform better. And we'll call those right now an outperformer because pretty much everything else is, getting wiped off the map. But of these sectors, we want to dive into some of these, and we're going to see what you think.
You brought up something good that just came to mind there, Seth. When you think about, for people who are just getting into it or want to have an arm's length, understanding of this and engagement to it, the best way to go would be, to buy the indexes, right? You can buy the S&P 500, you can buy the Dow Jones.
But you're not diving into the sectors at that point.
Correct, right? So you're buying the S&P as an example, right? That's the primary one, the 505 top companies, regardless of what sector they fall into. So that's kind of really, elementary is not the right word, but that's just kind of broad-based. I'm not really trying to pick a winner, but I'm going to ride the market mentality. The next level down would be to get into sectors, which we use ETFs to do. So if you say, listen, I got some S&P exposure, but in particular, I really like energy, or I really like technology, or I really like healthcare, you can buy an ETF that will kind of narrow your perspective and narrow your investment into companies that are only in that industry. And then when you get really fine-tuned and you really get your investment hat on, then you can pick out the individual equities where you're literally buying a single company. So it's kind of 3 levels of how to get invested. Index, super broad-based. Sector ETFs, which are narrow but are not a singular company, is still buying a bundle of anywhere from probably 20 to 100 companies. And then there's the individual equities where you're really taking a very specific aim at one specific company and trying to get the best return out of that you can.
I think as we kind of break out the sector conversation here, there's lots of sectors. Seth, you mentioned transportation, consumer staples, energy, pharmaceuticals, technology, utilities, healthcare. I mean, we can break out 1,000 different sectors if you want to get as granular as you want. The scary part about, the sector space and the sector performing is that, year to date, the only sector that's up is energy. And it's actually down recently, but it's up 29%. So if you had all your money in energy, folks, you've made money this year. And transportation is kind of interesting because in some transportation spaces, some of these companies are up very, very large. I was reading about the one company specifically the other day is up like 250% or some crazy number. So transportation has been interesting because of the demand overflow, but then also they've already got some of their contracts situated, so they're kind of running on free money.
And that's where there's kind of a little bit of overlap there is that the best part of transportation has been in the energy tanking business, right?
Yeah.
The tanker ships that are bringing crude all around the world, those have done the best.
Yeah.
So it's a transportation play, but it's a transportation company that's heavily involved in the energy markets.
And I think you bring up a really good point, Dan. And so for our listeners, as you were kind of working through how should I be investing, should I be buying the indexes, just buying broad-based exposure to the S&P 500 that has everything from Apple to Delta Airlines in it, should I be really kind of working in that space across the board, or do I really just want to own technology or utilities or retail? And that kind of conversation gets a little bit more intentional around how you should be investing and what you think, what space is really going to perform. Like if you all of a sudden get into retail and all of retail crashes and people aren't shopping because it's just way too expensive, then you're going to take a bath. If oil goes from $85 a barrel to $40 a barrel, well, energy is not going to be the play for the most part. So there's a lot of moving parts. As sectors create a different level or different type of risk that broad-based, necessarily doesn't. But yet, if you were in energy, you're up 29%. If you're in the S&P, you're down 29%.
Yeah.
And some of these energy companies are in the S&P. So how and I think that's where our conversation is going to be today is, how do you know as a listener, should I be really evaluating, sector investing and whether I should be looking at broad-based and maybe some sectors that might be of interest over the next 12 to 24 months?
At a glance, there are 749 sectors out there, folks. And
we're going to cover all of them.
You are listening to Money on Tap. You can call us at 855-226-8551 or info@yourmoneyontap.com. We're talking about cycles, sectors, and what's next. We'll be right back. You're listening to Money on Tap.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about cycles, sectors, and what's next. And, really, the sector conversation is one that clearly we enjoy. But for starters, we're going to jump right in. Of the Q4 top performing sectors, well, transportation. We've already kind of talked a little bit about this sector. And really the benefit of demand for petroleum products remains elevated. And how many times have we shared with our audience, with the EV vehicles or with the alternative energy solutions? That is a big driver in the news and our headlines. So much of that has to be pulled through the lens or the operating of petroleum. And there's just no way around it. It's a big deal.
Yeah, I think the thing about transportation, and I think the element that makes this extremely interesting is the fact that the pent up demand that's just still hanging over from COVID. There's so much stuff that people. I think about the stuff. My wife's like, my daughter ordered some Birkenstock shoes or knockoff ones, and she's like, they're shipping from China. She's like, I don't even know where they're in China because I can't even read the word of where they're in China. She's like, they're going to hit a tanker. We were joking around about this the other day. They're going to go on a tanker at some point, ship across the ocean, and then they'll be here in a couple months. There's just so much pent up demand. You go places, you really don't know if it's going to be in stock.
Yeah, these overseas tankers in particular, they're already booked out. There is no room on these boats for the next year or so.
Or two, yeah.
So their revenue is very well secured. Because of the global circumstance, I think it's become fairly predictable.
Yeah, I think that makes this a uniquely opportunistic area because kind of the generic thinking is well, oil is so expensive. It's just to ship stuff just doesn't make sense for companies and people aren't going to be buying them because it's going to get more expensive. It's like, no, the demand is already written into everything.
And it's also a sector of the market that's got some pretty high dividend-paying stocks involved in it. Some of them maybe a little too much. So like we've talked about in prior shows, you got to be cautious of that huge dividend number and what kind of underlying causes of that may be. But across the sector in general, that's a pretty prime dividend-paying sector.
Right.
Yeah, I could not believe that one of these stocks is up over 249% for the year, trading above, well, I would assume above the estimate or consensus estimate. But still, on the revenue, is expected to remain at nearly 4 times the traditional levels. And it's looking like those still might even rise beyond that.
Yeah, and there's a number of investments in that space that I think have very similar crazy numbers because of these companies are like we're pushing money out because these are some of our protocol as a company of what we're going to do for yield. We're making money and they're paying down their debt. They're doing everything they possibly can not to push some of this money out, which is pretty funny. So next up on our list is consumer staples. I think the consumer staples space is exceptionally boring. But it is, and that's for most of our listeners. No one really wants to talk about, the Costcos and the Pepsis of the world necessarily. It's kind of like, it's the mainstream, big old boy stock kind of investments.
It's not all,
It's not all,
boring.
I know. But consumer staples,
Philip Morris and the sin stocks in there, folks. So.
I know. Well, exactly. Like a couple sin stocks in there might make your day a little bit more exciting, I guess.
Yeah.
But
okay.
But, I think the thing is discretionary spending, it doesn't really come into play here. If you're trying to self-gratify on some level, right, you're going to go buy a Pepsi, that's a lot different than going to buy a car. There's this kind of overall purchasing power that exists in these spaces, and people they're going to get what they need to get and how they're going to get it. And these are the everyday purchases, and those are the ones that are going to play some interest in a difficult market like now.
I think it's a pretty straightforward thought when inflation's skyrocketing, the cost of living's going up, your rent is increasing, mortgage rates of taking that home purchase just off the table for you. Wherever you're at, people are seemingly tightening up on its spending.
This is where the sin stock comes in. It's like some of these people are going to run down to the store and buy a pack of smokes.
Right,
to figure
smoke them if you got them.
Yeah, that's what's going to happen with some of these scenarios. So, but it's not just that. It is the Costcos of the world, the Pepsis, the Cokes. When I hear consumer staples pop up on the thing, like I'm looking for maybe a couple bullet points and then I'm moving on. Like I'm looking for more of the scenarios that are more interesting, which takes us to that next sector, which is energy.
Yeah, energy has been the one leading and winning sector so far year to date. So if that's where you've chosen to place your bets, you've done well. And I don't really see any end in sight in that necessarily. I mean, the demand is still there. Certainly, we're coming into the winter season where heating homes is going to become a major factor, and they're already pricing in some increases there. The geopolitical influence of what's going on. I mean, some of the things that we kind of keep our eyes open for, I think, as an energy investor, is this notion of capping the price of oil. I know OPEC just made a decision to lower their output, and politically we're trying to take the wood to Russia as best we can. So talking about capping the barrel of oil. So those are things to stay tuned for. I'm not exactly sure what that would do with the market with the price of energy stocks, but
meanwhile, Warren Buffett's buying every ounce of Occidental Petroleum he can.
I think your domestic producers are safe as you can go. Your Exxons, your Chevrons, your Shells. I mean, nothing wrong there. But it has certainly been clearly by a long, long margin, the best performing sector. I mean, the second best performing sector was retail and it was down 7%. When the second best sector is negative, that's a tough market.
Yeah, it's a tough market.
Historically, too, on the energy sector, in rising rate environments, energy has been the number one outperformer as well, and it still is to date.
Solid point. Next up, we have so we're talking about our kind of the best sector space we think is moving forward into the fourth quarter here. We got pharmaceuticals. There's a lot of debate around pharmaceuticals.
Big pharma.
Big pharma. Whether you're into the vaccine world or not, I think that's probably not necessarily the focus of that I would be in. More of I kind of like the AbbVie, the Amgen. That's the space those are some of the stocks in the space that I like that area for the various medical approaches they have. Because I think with COVID kind of out of the picture, Pfizer, Moderna, they all have their space and what they're providing medically. But that kind of run on the vaccine piece it's not dead, but it doesn't have the power it had before.
No, definitely. I think a lot of the sizzle's out of that, but longer term, governments are still going to buy that stuff.
Absolutely.
So they're going to be still stocking your CVS and your Walgreens with all the vaccines you want to get. But interestingly, there's some other plays coming around the corner with some of those companies you just mentioned there and a few others around cancer and Alzheimer's.
Yeah,
so
and that's going to be a big one.
Changing fast there.
Well, I think the big debate is from the vaccine shots and all the question and concern. It was coming on Veritas and all these different things about where cancer plays inside the role of these inside the vaccines, and then the question of what Florida's doing with the medical guy in Florida. Gosh, I'm totally blanking. But anyways, he's speculating the concern of the increase of things that are coming out of some of these because of the biological makeup. Everybody's physically different, and this is opening up doors that people haven't seen before. So what is that going to do for pharma? I mean, hey, if you have a problem, you got to fix it. So that's going to create a whole nother medical sale.
And here, I was just going to say, here in America, the fix is another drug.
Exactly. And that's what they're happy to supply. So,
I was just going to say on the pharma side, why is it recession proof for the most part? Or historically has been, and it is because of the supply and demand. I mean, it's when you think of what's going on when I think it's hilarious that people go buy PepsiCo when they don't have as much money as they did the day before, but that's the way they're running their numbers. But when you have a need like your health, you're going to pay the money. You're going to go and you're going to get the drug. And then the other side of that is that what you were talking about was the pipeline part, because these pipelines, they're continuing to fill them. And you'll see these go up and down based on the news of what they've got coming online. And then, the FDA approves it, or they think they're going to approve it. The stock goes up, and then, or they don't approve it, and the stock comes back down. So those are kind of the things that are factors to really try to pay attention to outside of, what the company's done historically within rising rate environments or recessions.
Well, there's a whole nother separate reason why I'm very bullish when it comes to pharmaceuticals and healthcare across the board. And we've talked about this repeatedly, but we have 40 million Americans retired with 80 million more going to retire. What are they going to be taking more of? Pills and seeing the doctor. I mean those are the number one and two things of their entire retirement. So the demand there is just going to be exponential. It's not just what's going on around us in the world. It's, hey, we're going to triple the number of people totally retired.
Whenever we're doing a retirement plan with somebody, one of the conversation pieces is, whether we introduce it or they introduce it is, how much of this money you can allocate towards healthcare. And it's one of the only things that we specifically say.
You're either going to buy long-term care insurance and hope to pay less for that and, cover whatever needs you have, or you need to be prepared that you're going to drain down some portion of your assets because of the likelihood you're going to have one of you is going to have a significant care event.
Yeah, it's an element in everybody's retirement story.
I know. And in the new scenarios, we've done shows on it, but the life insurance kind of offset for people not losing all their money to long-term care is phenomenal. So, these are things that people really need to address, and the cost is going up. I read an article, and this is kind of off base, but I read an article about how in 20 years you may have enough money to pay for long-term care. You might have everything set up to pay, but there may not even be a bed because of the increase of demand for care.
Yeah, home health care, and 10, 15 years from now, those are the companies you want to get invested in is the providers of those services. Every nurse under the sun is going to be making a ton and just getting right there. So next up, we got technology as another sector, which has really been beaten down, so far this year. As a sector, and specifically looking at some of the individual companies, the price is just getting to be good.
One of the things is, cybersecurity, which is probably the number one space that we specifically take an investment in, is probably the part of technology that I think has the most room to run. And I find it very interesting. I'm personally highly invested in this space. There's just so much stuff going on. Everything financial needs to be protected. And so cybersecurity, every company, every financial institution, the cybersecurity is just, the demand is astronomical. The hackers are getting better and better and better. Think about it. You have to create a window that only certain people can climb through. You still have to create holes intentionally that are secure.
It's becoming that fourth insurance you need to have, right? So first off is your home. We insure your home and your property, right? Next is your health. And the next is after that is your life. And then the fourth leg is going to become your cyber identity, your online world, all of your passwords and access to this, that, and the other. There's going to be products created to insure your assets against hackers and online thieves, and it's going to be something that's going to become an essential part of everybody's just asset protection plan.
Yeah, I agree.
We're heading that direction. Folks, you're listening to Money on Tap. We are talking about cycles, sectors, and what's next. Well, what's next is you can call us at 855-226-8551 or info@yourmoneyontap.com. I realize you cannot call us at our email address, but it's just fun to get it out there for you anyways. We'll be right back. Don't go anywhere. Listen to Money on Tap.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about cycles, sectors, and what's next. It's a really fun topic, and we're going to jump right back into this. We were talking about technology and security in technology being one of the main opportunities that we see, and really is kind of inside of the technology a bit more pullback proof. And it's kind of a very interesting part of the sectors, because last time that we had this happen in the market, it was, last time we had a pullback was 2020. Technology was just unbelievable. If you were an investor in that, pulling out of that blip in our radar. And it was understandable because of pandemic, and it shifted the whole paradigm around, what happens in a market pullback and how things pop back. Right now, with bigger picture, longer term, that technology piece seems to be standing up again, which historically it didn't in the past.
Yeah, I think it's that's a change that's come in the world, and when the markets do rebound and some of this inflation, discretionary spending kind of opens back up, I think people are going to go back to technology.
Well, what is technology?
That's true. That's a complicated one, right? So, I'm thinking myself of the kind of the Apples, the Microsofts, I don't know about Facebook anymore, but Tesla, some of these companies that have typically been the stalwarts of the top end of the tech marketplace. But, truly everything's technology now.
Yeah. So it's like, how do you define technology? And I think that's we've talked about doing a show on that. So I'm excited where that comes from, Dan. So
next week.
Yeah. So utilities, I think utilities is another sector that is strong in a lot of ways. And I think utilities are a wonderful, predictable sector that really brings some stability to a lot of people's portfolios. It's not exciting. It's not sexy. It's just it's utilities, right? It's government regulated. It's the revenue and the earnings are super consistent for the most part. And in reality, I was just thinking of a client that I have that had inherited multiple electric companies that eventually became a very well-known name, and they just kept reinvesting dividends. They inherited the stock. They never touched it, and they became almost a millionaire from that one asset, just holding it and letting the dividends continue to buy, and it would go up and it'd go down, and it was all over the place. And now they have an asset that they just take income from on the dividends.
That wasn't Enron, was it?
No, it was not Enron.
Oh, okay. All right.
But they inherited this, and it's a lot of money in it. We've talked about diversifying and trying to reduce the risk of that one company. And, we've done a little bit of it, but not enough that's relevant because the tax burden is just almost unpredictable because they don't even have some of the cost basis. So it's definitely interesting, and it's a long story there. But, utility. Go ahead.
I'm going to jump in on this with you. I completely agree. This is a snooze fest for me when we start talking about utilities. Until I start looking on cash returns of 7% and 9% for the next 5 years, or some of those numbers around the utilities is really, I'll get behind that. I'll get a little excited.
Well, I think they're one of the the easiest kind of pass through industries, right? With inflation and costs rising. We've probably all gotten that letter in the mail that told us local electricity is going up 40% this year, right?
40. Mine's at 114.
Oh,
40.
Man. So it's just,
wow.
It's one of those things that, it should probably be almost a consumer staple, right? It's kind of got to have it, in that sense where,
well, you do now.
You need electricity.
You need electricity and you need internet.
Yeah.
It's like,
without those.
Yeah, it's a utility.
I'm not a socialist until it comes to utilities. Now I think we should rethink this whole thing.
Well, that's why it's government regulated. Well, so kind of the last sector we did touch on this briefly was healthcare. I think in healthcare between pharmaceuticals is a little different, but there's a lot of it. There's a lot of interesting opportunity, I think, in healthcare. Healthcare has taken a significant bath, and in the investment side, and I think you can see, some massive losses in certain areas of the healthcare space that I think over the next 20 years are going to be, the demand is going to be astronomical.
I think in healthcare we can look for some consolidation too between hospitals and insurers. I think there's going to be some winners and losers there, and there's going to be a lot of consolidation in that sector.
Well, I'm glad we actually got here, because I was having a hard time not talking about healthcare when we were talking about technology. And that's one of the things, like the subsectors of the technology world, this being one of them. It's going to be really amazing. Now, I think some of the best technologies that are coming to us are really around the service of the people, the people's needs. And we have that that story that Ben was talking about of our aging population coming through Americas, where people have some real needs, and technology being one of those places that there's needs are going to be fulfilled. Keep your eye on some of these companies, where they're coming from and how they're coming through with some of the new technology.
I think as we kind of, wrap this up right here is, just because you might not be, you might like the idea of the sector or the space, but you might not like the risk of owning the stock of the company. I think that's where, we were chatting earlier in the show, and alluding to it is the bond space. Some of these companies are offering bonds that, with the current rate increases and so forth by the Fed, that, just to be competitive in the corporate bond space, you could own some of these companies and pretty much have locked up a really solid return, with not the potential growth in the actual asset value per se, but just really get yourself a solid income yield. If the company is like, hey, I really like this utility, or I really like this healthcare space, the stock itself has a low dividend, but I think that's where I really want to be. Maybe you take a bond position and inject a higher yield in your retirement.
Yeah, I think in our dividend portfolios, we've tend to target, at least in the last few years, 4% is a great number. You can get 4% in a 10-year Treasury now.
Yeah,
that's considered a no risk investment, although that's questionable. But in general, 4% on a 10-year bond, if you're willing to hold it for 10, you'll lose nothing and you get your 4%.
Yeah, and I think that conversation really changes as you start going into, these corporate bonds. And then, I'm not necessarily recommending junk bonds, but as you're kind of going into that space, the cycle conversation of what we have in our title, the cycle sectors and what's next, is the fact that for the last, 5-10 years, we've been talking about how bonds have basically been an anchor behind a portfolio. You have a 60-40 portfolio, 40% of it's sitting in bonds, and you're not making anything. Well, now we have a whole new perspective. Bonds have real value. I think we're going to see a peak in bonds over the next quarter or two, and I think then we're going to start seeing some potential tapering or at least flattening, because people are going to project that yields are going to go down over the next 5 or 10 years, and that will force future bond rates down. So I think there's some real opportunity in the bond space that hasn't really been part of the conversation for the last decade.
No, when you're looking at what we kind of open the show with, or the segment with, virtually every sector of the equity world down, except for one, bonds is a place where you can go and at least garner some kind of a return that's positive. And there's some other safe money kind of opportunities out there as well, where if you just want to take a breather from the market, or you've come into some new money and you just don't really think we're at bottom yet and don't want to dive into that, the things in the CD world, for instance, relatively short term, and you can get yourself 2.5% working on 3% in a 1 or 2 year CD, when the rest of the market seems to be kind of crashing around you. 2% in a CD is better than -7 in a stock.
Well, I would one up you on that conversation, because we've chatted about annuities over the last few shows. And right now, in a 5-year fixed annuity, guaranteed 5% rate of return each year.
Yeah, I haven't seen that in forever, and
that's crazy. I haven't seen that
locked in.
Yeah, locked in 5 years, 5%.
Tax deferred.
That's lock a few of those in. That's something to take home with you right now, because if 5% really, and what's funny is 5% has been most retirees, guys. Right? That's mostly what we talk about for income. Well, let's take 5% off your assets. Like, well, now you can get that guaranteed fixed. It's like, wow.
Yeah. Well, there's some safe strategies out there that have come into light, come into favor, that haven't been there for a while. And we talked one show a little while back about the I bond.
Yeah.
It was up at 9.6%. It actually is going to be issuing in November, down a little bit at 6.5%. But that's someplace where, there's a limit on the investment you can put in there. Each individual can put $10,000 in. But, in terms of a, protected, guaranteed, safe rate, that's interesting. Now, it's only good for short periods of time, and your commitment to hold that is significantly longer before you have to pay a penalty to get out of it. But if that's something that you're looking for as kind of a buoy on the sliver of a portfolio, it's a nice rate.
Yeah, people talk about the back in the 70s and 80s, and crazy rates they were getting on CDs, 15, 16% or whatever. It's like people are like, I buy those all day long. It's like you're going to get to a point where rates are going to be so good that free locked in money before rates drop again, because when we hit recessionary events, they're going to be dropping rates to drive the market back up. That's what they're going to do. So,
folks, you've been listening to Money on Tap, and that's going to do it for us on Cycle Sectors and What's Next. So what's next is you can reach us at 855-226-8551 or info@yourmoneyontap.com. It's been a lot of fun, you guys. Make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.